Hi, and welcome back to Kingdom Wealth Creators. Thank you so much for all the support and encouragement over the past 1 year. It has been an amazing, tremendous year for us here at KWC. If you're new to the channel, please remember to subscribe to this channel and click that notification bell button, and also like this video and share it with as many people as you can. Please remember, everybody, to watch this entire video to get all the fun that you need on my strategy. All right, so today what I'm going to talk about is the strategies that I employ in my F&O trading. I started trading futures and options in July after the margin benefit came in, and so that's one of the key things. Okay, ever since the margin benefit came in, I've been trading mostly futures and options, and in July I had investment of about 11 lakhs in F&O. Today I have about 1.1 crores invested in, and my average investment over the last 8 months has been roughly 54 lakhs, and I have seen a return of almost 32 lakhs in profit on that investment. So in 8 months I have seen roughly a 60% return on my investment, and if I were to prorate that to a year, about almost 90% return. And so how is this possible? That's a good question, right? How do you manage this? What are the strategies that you use? And I've shared this often, a lot actually, to people, and so I would like to make a video about it since it's the financial year closing. So when it comes to F&O trading, there are a couple of things that I want to point out to you. One is that there's something called margin benefit, which the SEBI has introduced, where if you are hedging a position, especially in F&O, you get a margin benefit. Let me explain this. So if I were to buy a future in Reliance, and this would be my margin required, right? 1.17. Now, what would be the margin required if I wanted to sell a call? And I take a option and I go now the call 2,300. You can see that the margin was 63,000. So if I were to add these two together, it is 1.17 plus 63. What is that? That is roughly 1.8 lakhs. But here is the good thing about margin benefit. If I were to combine these two together, you can see instead of 1.8 lakhs, I just need to have a margin of 1.32 lakhs now. And this is what is margin benefit. Now you can do this together with two options. For example, if I were to also take a strangle by selling a put option. So if I were to sell a put option also, right? So where each option would have cost me 63,000 rupees before, now it's costing me, the margin is costing me about 89. So there is a significant saving that I accrue by hedging with options ever since the new margin rule came in. So that's point number one, the margin benefit. The second thing that I do is I diversify a lot. And so let me show you examples of this. So if you look at this, this is my Excel sheet that I maintain for every month. If you look at this, you will notice that I took a total of 18 positions in March. And these are the positions here. You can see them. And in Feb, again, same story. You see, I took about 25 positions totally. And again, you can see those various positions that I took. In Jan, you will see that I took 24 positions, and you can see the positions here. If you go to December, you will see 18 positions, and you can see the positions here again. So now you're seeing a trend. You're seeing that I take somewhere between 15 to 25 positions every month. And if you look closely, you will also see that there is a lot of diversification. There's, there's pharma, there's FMCG, there's IT, there is, banking, there is, auto, there is life insurance. So there is always a diversification in the number of shares that I take positions in. There's also diversification in terms of the sectors that I take positions in. So, and this really works. So the second thing that I do is I diversify. The more you're diversified, the less risk you have from one share going against you. For example, if you were to look at March, because I diversified, even though HCL Tech, it didn't do really well for me. I made up for HCL Tech in a lot of other trades. Let's take another example. See, for example, Tata Power. Even though I did get a good profit, the return wasn't really efficient. So, say I didn't do really well in this because Tata Power moved up and down a lot. But within the same sector, say another power company, NTPC, did really well because it didn't move that much. So this is diversification. Even in a sector, sometimes having one share that doesn't move a lot can counterbalance and make up for a share that moved a lot. And similarly, you can also diversify by having shares from different sectors. So even if one sector does badly, the other sectors would make up for it. That is the second reason why my strategy works is diversification. The third thing is that I take a lot of strangles. In the beginning of my FNO trading, I used to do a lot of futures hedged with options trading, and I still would pick that up if I knew the market was directional. But the problem now is that from March 2020 to now March 2021, the market was mostly going up, right? It went to a bottom because of the pandemic in March 2020, and then from March to December it has been a clear upward trend. But since then we've seen a range bound movement. Okay, we've seen 13,500, 13,600 to 15,400, 15,500. And for the last 3 months, the market has been moving in this range. We closed at, in fact, at 14,000, you know, 500, 600 or so. So you can see that this range is still there, and it's a 10% range. Okay, from 14,500, 10% above is 16,000, 10% below is 13,000. So if you see 13,000 to 16,000 is the kind of 10% range in which the market is going to be bound for a while. Okay, and so we can use that to do strangles really well. So let me give you an example. Yeah, so now Power Grid is a share that I have traded quite a bit over the last few months, and I'm very comfortable taking strangles in this. There's a reason why I would look at Power Grid. First of all, it is the margin required for Power Grid is not that high. Second, it can be a volatile stock, but it always tends to move in a range. And let me point out this to you. If I were to look at the chart of Power Grid, since say it did make a huge jump in Jan, but since Jan, look at this. It's been in this range of say 200 to roughly 240, 238. Okay. So we are looking at a share that's in a range between 200 to 240. Okay, and right now it's at 214. So what my strategy would be is that I would sell a strangle. Say now this is a reasonable strangle. I'm selling the 200 put and I'm selling the 235 call. Both of them at roughly premiums of 1.9. Okay, so what happens here? I would need about 1.52 lakhs as my margin, out of which I will get 15,000 as premium, and so my effective margin is 1.37. And then if Power Grid doesn't go to 200 or 235, I will get this entire premium to keep. Or if I close it out a little earlier, I might have to lose some of this premium, but basically I'll get quite a good return. Now this is a position that is kind of safe, not very risky. Now this is for someone who might have only 1.52 lakhs say as margin, but what if you're in a position like me where I have 1 crore? So my thought is that I would look at roughly 20 positions. So the margin that I can put for each position is roughly 5 lakh. And this position would require 1.5. So what I can do is I can just increase the position sizing, and so I will increase the number of lots. Now, what makes me decide which positions to take? So the fourth point here is I look for low margin positions. So let me give you an example of this. Okay. If you were to go to the NSE side, you can download this Excel which shows the basically the various FNO positions, and then I go to Zerodha to check the margin on each of these, and then I sort all the FNO positions by the margin cost of all of them. So if you look here, you can see that Dr. Reddy's is a very low margin share, which is probably why I tend to take trades in Dr. Reddy's. Then you might ask, why don't you do Alchem? The reason is that Alchem probably doesn't have as much liquidity as Dr. Reddy's. Similarly, I probably might not take Pfizer, but I would probably look at Dabur and Reliance. Okay. Similarly, I would probably look at Hindustan Unilever, but I might not look at Alembic and PI Industries or Aarti Industries or Torrent Pharma. But I might definitely look at Coal India. I might not look at HDFC, MC, or Emphasis. But IOC might be a good bet. CUB again, not. I might not take it all the time. LTTS not again. But Divis and Marico make sense. Again, look, Granules, ICSL, Lombard, IRCTC, McDowell's might not be the ones that I pick all the time. But Asian Paints, Britannia, NTPC all make sense because these shares are the volumes are quite good. If there's liquidity and they are low margin. So I will look at low margin shares with liquidity. There's also one more point to this, the volatility of the shares. Now, this is again an Excel that you can download from NSE. But if you look here, you can see some shares that fit the criteria on both levels. For example, Marico is kind of liquid and it has low volatility and it has low margin. Similarly, Dabur, Hindustan Unilever, Power Grid, IOC, Dr. Reddy, Asian Paints, TCS, ACC, NTPC, Britannia. So you're suddenly seeing a trend. You can see that there are shares that fit some requirements for me. One, they should be liquid. Two, they should have low volatility as much as possible. And three, they should have low margin. These three reasons are the reasons why I pick those shares. And then I enter Strangles depending on the return. If the return is not so high, I might not necessarily take that Strangle, but I'm looking at a rough 10% return. Why am I looking at 10%? One, it reduces the risk. The more further I take it out, the more further that my put and my call are from the strike current price, the less risk that I carry. And for the risk that I'm carrying, 10% is a very good return. Now, I might close it earlier, so I might not always get 10%, but I'm fine with that. So my conservative return is somewhere between 3 to 8%. If I get more than 8%, I'm very happy. If I get between 3 to 8%, I'm really good, it's fine. But based on this strategy, that's a very good expectation, and it doesn't require you to sit on the market for so many hours every time. It reduces a lot of stress, especially when the market might move violently in a direction and the volatility might shoot up, option premiums might shoot up. But you know that as long as your boundary conditions are not hit, you're safe. It reduces a lot of stress. So this is my strategy that I've been employing for a while now, and it works for me. And I think it's something that anyone with decent capital can employ without having to try to take a lot of risk, without having to trade every day, without having to be on the market all the day. And so that's a very good way to get a good return from the market on a monthly basis. So I hope this helps.